Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us. On the program tonight, well, it is the end of the financial year and we're welcoming in a new financial year. So it's Happy New Year to you all. And our first guest is June Bailou of TenCap. And I've asked her to look at the three stocks that she thinks will do well in 25-26. I've also got Paul Rickard coming in, and Paul's going to look at this share purchase plan of Xero. Xero is a great company, but Paul's got a few question marks over whether the share purchase plan is good for all shareholders. And then we have Adam Dawes of Shaw Partners, and I've given Adam the same challenge I gave to June Bailou. Give us three stocks that will do well in 25-26. And then we have Simon Pressley. He's one of the best property price predictors in the country. Comes from a company called Propertyology.com.au. And what he doesn't know about real estate, you don't need to know. So I want to know what's happening to house prices around the country and overall across the country as well. So let's kick off now with June Bailou of TenCap. Well, Happy New Year, June Bailou. Happy New Financial Year.
Happy new financial year. What a year it has been. And it's quite incredible. We have such a strong performance from the share market, given all sorts of uncertainties we've gone through in the last 12 months.
If you had to pinpoint the reasons why tailwinds have outweighed the headwinds, what would you say were the main reasons?
Look, the main reason is all being that share market is trying to look forward. So, we have moved from, worry about inflation, worry about interest rate going the wrong way, to now the inflation under control. Interest rate is now being already be cut twice, another one coming soon, and then more to come this year. And then the share market look forward to the next year. Things should definitely pick up and get better. So I think it just sort of positivity mixed with there's some of the tough headwind now turning to tailwinds. For share market really to pull through and be so resilient. Moving forward.
Have you ever had an investment life where one political leader has such a big impact on what the market might do day to day?
Not at all. I've never seen share market for the last 25 years, over 25 years. I've never seen share market so fixated on the news headlines. One news headline can send the market into tailspin, which has been incredible impact. But the good thing is, what that does is provide buying opportunities for us long-term investors. So then our share market deliver it's not probably the best financial year performance since COVID.
Okay. Now, what about also, what's the role of artificial intelligence, do you think, in helping positivity towards stocks?
Yeah, that's definitely been an important driver as well. If we look at our tech sector, has done incredibly well. It's probably one of the best performing space. It is driven by a lot of hype and excitement into the technology, and then what's happening overseas with the AI thematic. So that's definitely extended the life and the run of that sector. We've seen that being one of the top performing sector. But the other top performing sector, which is not surprisingly, it's gold companies. Some of the smaller to mid cap gold has done incredibly well. In the middle of all these changes and uncertainties in the market.
Of course, then there's this very unusual stock called Commonwealth Bank of Australia that also has behaved like a gold stock.
Oh, it's incredible. Just looking at sort of return this company has delivered. It is probably one of the best performing large cap stock. And for such a large company to perform so well, this just be incredible. If you actually look at the 6 month versus 6 month, the first half of the year for Commonwealth Bank is actually driven by better earnings, better capital return, doing a bit better than expected to drive the share price higher. But the last 6 months, and particularly last 3 months, is actually purely driven by foreign investors. Foreign investors have had way too much US market, and they are looking to diversify just a little bit. But their little bit is a lot for a small market like Australia. And then they just buy the top blue chip company, and CBA is an easy one to put in.
Okay. So I've asked you to look at the three stocks that you think are going to be the biggest potential gainers. So let's kick off with your first one.
Yeah, look, the first one, look, some of my names is going to be the continuation winners, and some of them are probably more bottom picking. So the first one is I'm going to put Life 360, still at the very top of that list. I know the company is done incredibly well. Last 12, in fact, last quarter, it's gone up over 50% because of strong earnings. But I think there's a long way to go. It just started benefiting, from start selling some of those advertising revenue, on top of already a very, very strong active user base there in the US. And this is not to mention other markets to come online. So I think this is number one for me, always core part of the portfolio. And the next one, next one is a little bit of bottom picking, but look, it's a quality name that we all know. That's Cochlear. I think Cochlear, has had its tough times in the last 6 to 12 months. Partly because things are getting a little bit tougher around the world, and cochlear implant is expensive. But the core reason for some of the earnings missing expectation is that it's got a new processor coming out, and usually when there's new product coming out, people don't really spend up and buy lots of its old products. So the challenge is that it's going through this transition phase, and with the new product expected to launch first thing the next financial year, this month sometimes, we do think that this company will go through a couple multi-year sort of, catch up in terms of market share, and it will do very well. And it is a great, blue chip business, has been executing for years, and this is just a short-term blip and a good buying opportunity. Next 12 months should do pretty well.
Okay. Is Cochlear being challenged by any new rivals or innovations that could mean that it's not as a dominant player as it has been in the past?
It hasn't really. There is a couple of studies in the pipeline, potentially looking at healing some of those hearing issues. But these are still very, very early stage. We don't expect that to change any of the market growth outlook. This is actually quite different from the likes of CSL, where its product growth is really be challenged, and a lot of people are asking, where's the growth going to come from over the long term for CSL? But Cochlear is firmly in that growth camp. It's just at the moment just a bit of a cyclical sort of weakness before the next product coming through.
Okay. And on the subject of rivals, I didn't ask this question when you're talking about Life 360. Uh, does Life 360 potentially have threats from some of the big tech companies that might want to eat their lunch in a sense?
Yeah, look, to be honest, the Life 360 is first started the tracking business way before Apple started its Find My iPhone. So when Apple first launched its Find My iPhone, everyone thought life is over for Life 360. But what it has done is that it created more awareness in that whole circle. As we all know, with tech companies, it's an ecosystem, it's a circle you created. This company has over 80 million active users every month on its platform. In fact, it is one of the highest used, social platform there when compared to some of the most famous names like Facebook and others. So, it's got a very strong platform, and all it's doing now is actually trying to monetize that platform, through many different initiatives. One is, you create the paid circle, and then the two is that, start doing a bit of advertising. At the same time, you started creating some of those data. You can do the insurance product, and then they start doing the pet product. There's so many verticals they get add on. So, when you have a big base like that, there's just so much opportunity that they can go from here. They never say never. The competition is always there, but because it's the first, it is the incumbent, and it's got such a large base, it's just very, very hard to dislodge. In fact, some of the tech companies, such as Google, has previously expressed interest in Life 360.
Yeah. Okay. Finally, there's two. What's your third one?
The third one, I'm going to be a little bit more controversial. Look, I think it's this company, recently gone through a bit of challenges. I'm going to put a dare in the basket. The company struggles somewhat because look, retail condition is quite challenging at the moment. They haven't got some of their categories right. They had the profit downgrade, share price down a lot. It is very, very cheap, and we are at the bottom of the housing cycle at this point. As we know, a dare is more housing housing related sort of, Manchester and all these products. So when housing markets start to turn, which we are seeing the early signs of it, these products will sell. They will fly out of the door. And the good thing is balance sheet is strong. There's not much expectations now from consensus analysts, and it is very, very cheap. So, I throw that in as a speculative buy. Because I think next 12 months is all about companies linked to the lower interest rate.
Yeah. Just before you go, a couple of people have emailed us and asked, what's the minimum amount that you can invest with TenCap?
Yeah, so the minimum amount is $25,000. So you can just go on our site, and we also on every platform. So whether you're on your Hub, Net Wealth, and most of the platform we on there as well to make it easier. But $25,000 the minimum.
Okay, great stuff. June Bailu, thanks for coming on. See you in a couple of weeks' time.
Thank you very much for having me. Thank you, Peter.
And that was June Bailu of TenCap. And now coming up is Paul Rickard of the Switzer Report. And I want to work out whether we should participate in this Xero share purchase plan. Let's talk about Xero. A lot of people asking questions.
Yeah, it's done a big issue last week. It bought a business in the US called Melio, which it paid effectively 3.9 billion Australian dollars for, and has raised a lot of capital both in the institutional market last week and shortly with retail shareholders.
Okay.
It's essentially sort of adding to its US business. It's Xero, of course, is basic accounting software. It's been trying to add in things like payments and other sort of things that small businesses do. This is what it's doing in the US. It's sort of, rather than trying to build it itself, it's buying both customers, but also a company that's been growing very strongly called Melio Payments. But Melio also does things like it helps small businesses prepare things like accounts payable, accounts receivable, ledgers.
So it's kind of in Xero space.
It's basically trying to make it so that if you're running a small business, you have a one-stop place for software for bookkeeping, payments, accounting, et cetera, et cetera. So you don't have to keep separate things on a spreadsheet and then bring it back into your accounting platform.
Okay, this is for those people who hold Xero shares. Do you think over time this is going to be a good acquisition?
Well, it's paid a very big price. It's actually buying this business at 14 times current revenue, not earnings, 14 times revenue. They say after synergies and so forth, it's more like about 8 or 9 times. But that's a big multiple. That reminds me sort of a bit like the dot-com boom when people would buy things on revenue multiples.
Don't say that, Paul.
Now,
scary.
Melio has had a compound annual growth rate in revenue over the last 5 years, about 120%. So it's growing very strongly. And Xero has, it's always been really strong in Australia and New Zealand. Had a bit more of a challenge in the UK, and the US is where its focus has been. It's really struggled to make much headway in the US, despite that market being, lots of people still using non-cloud-based solutions. American business practices, particularly around things like bookkeeping, they're still using checks and all sorts of things in America. So it's a long way behind some of the digitized stuff that we see in Australia and to a lesser extent in Europe. But to be honest, Xero hasn't made a lot of headway in the US. It's struggled. This is sort of buying customers, and this is sort of a buy rather than build approach. And look, the top dollar, I think, is what the market has viewed as purchase as.
Okay. Would you sell your Xero shares, Paul?
Look, I wouldn't sell my Xero shares. I think what investors, retail investors now have to consider is whether to put more capital into Xero, because apart from raising 1.85 billion in the institutional market last week here in Australia, there's also now a share purchase plan, which means that every retail shareholder can purchase up to $30,000 worth of new Xero shares at the same price that the institutions paid last week, which is $176.
Yep. What's the current market price?
And look, Xero is trading about $182. So it got away with a big placement last week. The market's absorbed it. The price has gone up on the placement. Sure, it's down from where it was trading before the equity issue. But retail shareholders will have until the 21st of July to work out whether to cough up that money. My guess, Pete, is that we've seen, with other times we've seen big share placements. Sometimes the stock, despite the intrinsic benefit of the acquisition, does take a while to just settle down.
Well, next DC went backwards.
Next DC
It
went
didn't pop
back.
the Trump stuff, didn't it?
Quite a few that have raised a lot of money. Goodman's did a big capital raising and went backwards
Yeah.
not so long ago. It just means there's a lot of paper out there, and sometimes it's a bit early to judge this after a couple of days.
Yeah.
I'd be inclined just to, and I'm a Xero shareholder, just wait a little bit. I've got till the 21st of July. I don't think I'd be selling. I mean, the market, you got to say, the institutions have put their money in, so they seem to like the transaction.
Yeah.
Maybe they're smarter than the new riders say they've paid too much. But certainly, this is a big transaction, top dollar being paid, a lot of money being raised, and I guess it's going to take a little while for the market to digest the extra stock.
Yeah, and I guess the bet should be you go in at 170,
176.
176, or you hope it falls to say $1.70 after the whole thing gets done and dusted, and you buy in cheap at $1.70.
Yeah, there's a little bit there. I mean, you and I are huge fans of the product.
Yeah,
but
one of our favourite
I
companies.
do think as a Xero user, we've had 3 price increases.
Yeah.
They've really demonstrated their ability to leverage the price up a lot in Australia.
I think you're the only person who cried tears of blood when the price went up.
Well, I've tried it now for 3 years in a row. It's got pretty expensive, right? But it shows you how, once you get that into the accounting and the market, and your accountant uses Xero, you use Xero or both, it's really sticky, right?
Yeah.
And it's very hard to turn around. And to their credit, it's a great product to use.
Yeah.
It is really built with a customer in mind.
Yeah.
But I think it's become a little expensive. But the US, they haven't been successful at. And this is really the next big story in the US. And to be honest, I'd say probably Xero's now trading as though it's a US stock. It's really the life of, that company's going to become, say, a $300 stock.
Yeah.
It will depend upon its success in the US, not in.
And I guess if it has a bit of success, it probably could list on the NASDAQ, and that would give it another bit of headwind, or tailwind.
That's the other way we might be looking at it. So a big transaction. My gut feel is they'd probably pay top dollar, but let's wait and see.
Final question: Are you going to take up the share purchase plan?
I'm going to put that decision off for a couple more weeks, and I think if it does start to come under a little bit of pressure, I'm probably going to say no.
Yeah,
but I
think
think
climbing.
Well, yeah, as I said, just more so because I'm a little worried that companies have had big capital raisings after really, strong share price appreciation, done big acquisitions. The market takes a while to digest the paper, and I just have a feeling that it may be one of those cases.
Okay, so we'll get you just before closing.
I'll have a much stronger view about whether I'm going to participate or not.
Great, we'll catch you then. That's Paul Rickard of the Switzer Report. And now we have Adam Dawes of Shaw and Partners, and Adam's got the same challenge that I gave to June Bailou. Give us 3 good stocks for 25-26. Thanks for joining us, Adam.
Well, it's great to be here, Peter. Happy New Year.
Yeah, Happy New Year to you as well. And
absolutely.
What I'm hoping is that you actually do give us reasons to have a really good 20, 25, 26 with 3 great stocks. So any further ado or me sucking up to you or whatever, let's get on with the game. And
get on with it. Look, the first one is, Peter, you and I talked about this probably about a month ago, was Next DC. And it was looking very, very, very unloved. But now it's actually started to break out of a little bit of a trading pattern that we've seen. And in fact, I think it looks really, really good again. So since we spoke, I think the stock's up around about 12%. And for all those people that potentially did listen to us back then, would be very happy. But however, I still think that Next DC side of things is going to continue to move forward. So I certainly think Next DC is one of those ones that will do very, very well this year. Look, the thematic of data centers is still there. I think that hasn't gone away. Demand is still there. Next DC definitely in the box seat and has lagged a lot of the other international operators as far as the data center operators. And so I think this one, definitely deserves one to be put on the watch list and also a good buy for me for 2005-26.
Yeah, it's funny when I say to people, I talk to them about data centers and Next DC and Goodman Group. I say to them, how many photos do you have on your phone? And like the numbers are unbelievable, and there are an unbelievable number of people in the world. This stuff has to be stored, doesn't it? And it's like
Yeah.
it's limitless. It really is going to be limitless.
Yeah, absolutely. And then there's lots of other stuff as well. I've been doing, I don't know if you've seen, there's lots of chatter around the marketplace about humanoids.
Mm.
And basically, it's robots that are basically going to be taking over. One for aged care, two for your home. I mean, everyone's probably got a robot vacuum. It's not your wife, Peter. It's a robot vacuum. Yes. And so, in other words, there's lots of these things that are now starting to get integrated into our lives.
Yeah.
How else are they all going to run? It needs to be on chips, so AI. But then it also needs to have data centers to store that data somewhere. And that's just the starting point for a lot of this humanoid interaction that we're going to see over the next 10 to 20 to 30 years.
Yeah, and artificial intelligence is going to really explode and place enormous demands on data centers. So that one will give you a big tick, no questions asked. Let's go to the second one now.
Was there supposed to be questions? Hang on, was this you maybe not wanting to choose some of my...
No,
No?
but yeah, but I'm not going to be a yes man. If I think your selection stinks, I'll tell you, but then you'll tell me why I'm wrong. I hope.
Oh, yeah, there you go. There you go. All right, look, the second one is, I guess going on that humanoid theme that I've been working with, and there's been a lot of work. UBS have done some, Goldman Sachs. In fact, Goldman Sachs has actually put out a humanoid 100 index. So that's something new that we need to keep an eye on. But it is basically the top 100 stocks that will take advantage of robotics and robots inside homes, as well as driverless cars and all that. Now, the ones that are easily picked, Tesla, Nvidia, those kinds of things. But how does that relate to Australia, and how do Australians take advantage of it? And it's just a little company that's called Linus, rare earth producer here in Australia. Obviously, it has done very, very well over the last sort of 6 or so months when China or America put a ban on rare earth or taking rare earths from China. Linus is definitely sitting in the box seat with that. And certainly you've got a Luca as well coming into that rare earth or heavy rare earth space. But I think Linus is one of those ones. And if you wanted to get some more information, I can send you the 140-page research document that has been put out by a couple of research analysts that are really showing you how and what the starting point of this humanoid robotic adventure that's going on. But rare earths and Linus as one of the companies that has been picked to be able to then supply the different types of needs or metals and those kinds of things that are needed to build these robots moving forward. So that's my number 2 pick. To get one for the future. It might be a little bit early, but I still think that there's some good stuff coming in with Linus. And that was my number 2 pick.
And that was and so Linus figured on this Goldman Sachs list of companies well positioned to do well out of this humanoid trend that you're really pushing hard today, man. I'm gonna have to start calling you Adam Humanoid Dawes.
Like, you call me what you want, but don't call me late for dinner. All right, next one.
Okay, so it's a goodie but an oldie, or an oldie but a goodie. But go on.
Oldie but a goodie, yeah. So look, the next one is I'm gonna go down a little bit more speculative side of things now. And it's got a lot to do with what's happening in the US and certainly with defense spend in the United States. There's certainly a lot that's going on there. I own some stock of this one. I have talked about this one before. It is a stock called 3DA, or Amero is the name. It's about 38 cents at the moment. Starting to get a little bit of love because of what's happening with the defense spend in the United States. As I said, I own some of this, so everyone needs to do their own research before they decide to buy it, and it is a high risk stock, so we need to be careful. But what it does is 3D metal printing, or it has the additives to put in for 3D metal printing. And that 3D metal printing is basically going along the lines of if you need to build a missile, if you need to build some really high-tech gadgets, and certainly the Raytheon, Boeing, and all those kind of guys need this 3D metal printing to be able to build these products. And especially with the amount of infrastructure and defense spend that is going in the US. They are based in the US and they've got everything in the US, so there's going to be no tariffs. This is an interesting one. It's starting to get a little bit of a wriggle on. AL3 got an interesting write up today as well, and that's in the same space as that metal additive business side of things. but we really like 3DA, sitting at about 38 cents. Not very demanding on any of the metrics, but it is a high risk one. So I gave you some oldies but goodies, but a new sort of speculative one there for you as well.
Is the ticker code 3DA?
Yeah, number 3, Delta Alpha. Yeah.
Okay. And the name of the company is Amero?
Amero. That's right. Yeah. Amero. It's an
Right.
interesting one.
Okay. So let's just finish off on your overall view for where stocks you think are going to go over the next 12 months. Now,
Yeah.
obviously, the big curveball is we don't know what Donald Trump will do with tariffs, and that's the uncertain one. I guess we're all hanging out, hoping that Taco proves to be true, that Trump will chicken out on the aggressive nature of the tariffs. Sure, he stuck it to Canada over the weekend, which is not a good sign. Yeah, he could back away from it if Canada's prepared to talk. What's the feeling at Shaw and Partners about what the local stock market can do? I'm comfortable saying to some people who ask me, with interest rates coming down, I figure a whole lot of companies outside the top 20 that haven't done well are likely to start doing well. And therefore, I wouldn't be surprised to see a 10% gain for the market going forward. Well, but is that too confident, too optimistic?
No, I don't think it's too optimistic. I mean, we are coming into reporting season, so August is going to be really, really big. Now, just looking sort of and getting a feel for what those, is there going to be potential earnings downgrades or is there going to be potential earnings upgrades? I think there might be more upgrades than downgrades coming through into this cycle. I just got the feeling that even though the tariffs have started to sort of bite in some areas, they haven't really flown through. And so we really can't put any real numbers or how hardcore numbers on how that's actually going to be affecting a lot of these companies. So I'm sort of very of the mind that I think certainly markets should be okay. Now, remember, we were at 8,600. We went all the way down. We're all the way now back up again to around that 8,500, 8,600. And it does make it a little bit tough for markets to go, okay, where are we going to go next? Remember, May is usually a softer month. Obviously, that wasn't the case because we already had our full February, March anyway. So we haven't seen that. I think reporting season is going to be holding up quite well. I think the dividends are going to stay okay. One sector that we've done a lot of work on is the healthcare sector, and we still think that that's been probably unloved over the last sort of year or so. And so the healthcare sector is probably the number one pick if you were looking for a sector pick to look to put some more money to work. And certainly CSL looking a little bit better today. ResMed near all-time highs. Telix coming back off its all-time highs, but looking pretty good as well. So I think overall the market, we do need BHP to do some heavy lifting. We do need Rio and Fortescue to do something. Now, the iron ore price is keeping that back a little bit at the moment. But the US dollar, no one's really talking about it. The US dollar has fallen quite significantly over the last 3 or even 6 months now. And so that's going to help our commodity market start to move forward. Be a bit cautious on gold. I think you just got to, there's still, while Trump's in power, I think gold will stay strong, but there's been some movements there as well. And copper does look pretty good, and we've always been a fan of that one as well. So I think overall, if we get the resources doing some of the heavy lifting, I think this market should stay high and should do well. And don't ask me where CBA is going to go by the end of the year. I have no idea.
No, we don't. All right. Thanks for joining us, Adam. See you in a couple of weeks' time.
Stay here. Thank you.
And that was Adam Dawes of Shaw and Partners. And now I've got Simon Pressley of Propertyology joining us to look at where house prices are going to go in 2025, 26. And this guy is really good at understanding the direction of property prices. Thanks for joining us, Simon.
Thank you, Peter. Always good to have a chat.
Yeah. So your latest penning of your views on real estate gives us an idea of where you think house prices are going to go. So why don't you kick off by telling us what your expectation is for house prices?
Yeah, the report you're referring to, we sort of did a bit of a summary of, taking back to when all the lemon suckers of the world kept saying mortgage cliff and interest rates are, were about to rise. And when they do rise, no one's going to be able to afford their mortgage. There's going to be all these distressed sales. Property markets are going to crash. Well, it was May 2022 when the RBA first raised interest rates. So that's 3 years ago. Some markets have lost a little bit of value in that time. Some have gained a little bit. I've got some numbers for you, happy to share a bit later, Peter, but some have grown by as much as 50% during what goes down in history as the single sharpest rise of the RBA cash rate ever. We've had markets that have had 50% growth in their median house price in just 3 years.
Mm. Yeah, it is an interesting one because as you know, you're old enough to remember when interest rates were a lot higher than they got at the top. And I've been, wondering how come this economy hasn't really capitulated like it used to when you raise interest rates so aggressively. And I guess there are a couple of things, and these couple of things are in your patch. Over that period, immigration was very strong. So, how important is immigration to house prices, Simon?
It has not believe it or not, but the evidence says overseas migration has very little impact on property prices. In fact, population growth, whether it's from overseas migrants or whether it's from natural growth, so babies being born, or someone moving from Brisbane to Sydney or vice versa, population growth is not housing demand like people think. Whether it's property or anything else that humans acquire with money, demand is a transaction occurring, and 95% of properties that are purchased in any location in Australia every single year are purchased by the existing resident population. And if anyone listening to this interview reflects on their own life and asks themselves, how many different homes have I lived in? There won't be too many people that are saying, the home I'm living in now is the same home I've always lived in. But that same person has only influenced the population figures once.
Okay.
So
All right. So, listening to us might be a young person who hasn't bought a place yet and they would love to. But as you well know, we have a supply problem of properties in this country. Is that a fair and correct assumption?
it is, but I don't think people understand supply very well. Certainly, do we need to build more? Yes. And I can absolutely guarantee anyone who's interested in property markets, you can go back every single year for 150 years, and every one of those years, Australia has not had enough homes. So it's always been a problem. But when it comes to supply and its influence on asset values, whether property prices are rising, going backwards or going sideways, that has very little to do with how many homes are being built. As I said earlier, 95% of properties that are purchased in any location in any year are purchased by the existing population. And most of what they buy, Peter, are not new. They're established dwellings. So whether property prices go up, down, or sideways, is a relationship between the number of active buyers and the number of properties that are available to purchase. And I think a lot of times people just think, oh, well, they only buy new ones. Well, very, very few people buy new ones. So the metric that's most important to me as a professional property market analyst is the volume of properties listed for sale and how that figure compares to whichever location's historical trend. Now, that number today is really low.
Yeah. Well, and I'll ask you this question, given your grasp of real estate history in Australia, when was the time when the volume of properties for sale was really big, historically big?
We got to go back to, it wasn't really big, but an equilibrium would have been around about 2010-ish. So 15 years ago. And progressively since then, it's got smaller and smaller and smaller. We reached an all-time record low number of properties listed for sale the year directly before the pandemic. Give or take, we would have had about 220,000 properties Australia-wide listed for sale. And we're at a pretty similar figure to that now, but we've probably got an extra 2.5, 3 million people now. Plenty of equity in property. So a lot of people upgrade their home. So when someone, goes from 10 years ago being a first home buyer, now they want a bigger home or a nicer home, that's demand. That transaction is demand. And so if at the time they're looking to upgrade or invest and there's very few properties to choose from, there's instant pressure in markets. There's instant competition, and that's what forces property prices up.
Okay, investor demand, investor property demand. How significant is that in driving house prices?
Well, it doesn't matter who the buyer is. first home buyer, upgrader, a retiree that's downsizing, or investor, doesn't matter. Someone buying property is a transaction, is an extra piece of competition. Rule of thumb, investors represent 30 to 35% of buyers of real estate in a typical year. They're understandably more active in markets where they've got confidence. Now, we do live in a country with 8 capital cities and 400 regional townships. So local conditions in each of those individual towns and cities is always going to be very, very different from one location to another. You'll know, like in your hometown of Sydney, there's been times when local confidence has been strong. And property investors, unfortunately, are creatures of habit. They tend to only buy in their own city, whereas they should be completely borderless. But when confidence is weak, investor activity in that town will be weak, but they might be investing somewhere else where there is local confidence.
Yeah, I can recall when Bob Carr was the Premier of New South Wales and Michael Egan was the Treasurer, they came up with 2 or 3 tax changes to affect investors, and real estate prices in Sydney went sideways for quite some time. You might recall that. But I'm now thinking, if one of your wonderful Queensland protege mates, Jim Chalmers, gets involved in unrealised capital gains for people in super having more than $3 million in super, they could start looking at properties. As a financial advisor, I might say to some of my clients, well, you can always upgrade to another house and renovate it. And when you're sick of that, you can downsize and get the capital gain for free and go into a retirement home or whatever. There's going to be, I suspect, if Jim goes with this unrealised gain, a lot more people looking at properties. Is this being factored into your analysis of what might happen over the next year or two?
Firstly, if anyone ever touched that piece of legislation, they would be a horrible human, in my opinion. But would that impact on property markets? Not a lot. At the end of the day, for property prices to go up or down, it's really a reflection of what the critical mass of people are doing. Would there be like tens and tens, hundreds of thousands of people buying or selling real estate due to one piece of legislation such as that? Probably not. So I don't think it have a big impact on market values. But would it impact some households' retirement nest eggs? Yeah, definitely would.
Okay. So what's going to happen with house prices, and tell us why?
I think we're in for steady growth in most markets. There's still going to be some boom markets. Every single year there are some boom markets, but we're going to have more steady growth. What people, I think, neglect to realise with interest rates, they focus on, if interest rates are going up, they focus on that's got to be bad for property markets because it's going to cost people's mortgage more. Whereas what they should focus on, they are going up because the economy is strong, and a strong economy means a roaring hot property market. Interest rates go down when the economy is softening, and people then think reducing interest rates is going to cause property prices to accelerate in growth. Often the opposite happens because the RBA has some concerns about the economy not being as strong. But it's always different cities will do different things. If I can share with your listeners, Peter, this is what's happened in different parts of Australia over the last 3 years. The numbers exclusive for your audience. And this is during the sharpest rise in the RBA cash rates history. 3 years. Markets that have had less than 10%, in some cases they've lost a bit of value over the last 3 years. Melbourne, Hobart, Darwin, Canberra, 4 out of 8 capital cities. And some regions that have had less than 10% growth, Ballina, Noosa, Orange, Geelong and Ballarat. Sydney's had about 12%, for your listeners who've got an interest in Sydney. Now, roughly 30% growth over the same last 3 years. Brisbane, Gold Coast, Hervey Bay, Cairns, they're all Queensland. Albury, Armidale, Wagga, all in New South Wales, and Geraldton in Western Australia. The next tier, property markets that's median house prices increased by roughly 40% in the last 3 years. Adelaide, Perth and Victor Harbour, 50% growth. The very best performed property markets in all of Australia over the last 3 years are record high interest rates. Townsville, Bundaberg, Rockhampton, Toowoomba, Margaret River, Bunbury and Murray Bridge. 50% in 3 years.
Where did Byron Bay fit into all that, no?
Byron Bay, Coffs Harbour, sort of all the Northern Rivers region had zero growth in the last 3 years. They probably lost about 15% during that really steep part of the RBA rate rise cycle, and have gained not all of that, but most of that back in the last 12 months.
Because during that COVID period, they really rocketed, didn't they?
Yeah, Byron Bay, Orange, Launceston, they were the best performed property markets for about a 5-year window there.
Yeah. Okay. So going forward then for 25, 26, are you expecting house prices to head in general up, or are they going to go sideways?
In general, up, and more than just trickle. In our annual market outlook report, admittedly that's 6 months old now, but nothing's really changed fundamentally with property markets. Of Australia's 25 largest cities, we forecast that 20 out of 25 would experience growth, and about 15 out of 20 of those 25 would experience boom conditions, and we define boom as 8% or more growth in a calendar year. So 15 out of 25 enjoying that sort of growth. That said, it might be. I made that forecast directly before New Year's Eve, anticipating there might be 1 or 2 interest rate cuts this year. We've already had 2 in the first 5 meetings. We've got 5 more meetings to go this year. Your guess is as good as mine, Peter, but I wouldn't be surprised if there's at least 2 more cuts.
Yeah. The economists are on your side. Could even be 3. Look, Simon, always great to see you. If people want to read your stuff, you'll be putting some on my website as well, but also propertyology.com.
.com.au.
Yeah. Thanks, mate. Thanks for joining us. And that's your show for tonight. Thanks for joining us. And don't forget, if you need more insights to help you invest more wisely and to see things that other people will not see without the experts that we have working at the Switzer Report, think about becoming a subscriber to the Switzer Report. Go to switzerreport.com.au. Thanks for joining us again. See you next week.